of India Governor Shaktikanta has kept policy rates unchanged as was widely expected. The GDP projection for FY22 is at 10.5% and he has struck a very optimistic note as far as the economic recovery is concerned, quite in sync with what Finance Minister Nirmala Sitharaman said while presenting the budget just earlier this week. There has also been a commitment to really support the government's aggressive borrowing program. They will have to borrow much more in a post-pandemic year, and that is something that the governor also talked about during his presentation of the monetary policy and in the press conference that followed. But quite a few directional changes and suggestions also coming in from the monetary policy, indicators really coming in. One big change which has also been put in place is allowing retail investors to access gilt G-Secs and government securities. So what are the main highlights of the monetary policy? What kind of direction does it show us for the way ahead, and where are interest rates headed? To speak on this, I'm joined today by Kaushik, Chief Economist India of Deutsche Bank, and Upasna, Bhardwaj, Senior Economist at Kotak Mahindra Bank. But before we start the discussion with them, I just want to play out for you a soundbite from Shaktikanta, RBI Governor, where he struck a very optimistic note, saying that 2021 will be the year when we undo the damage of 2020. Listen in.
Going forward, the Indian economy is poised to move in only one direction, and that is upwards. It is our strong conviction, backed by forecasts, that in 21-22, we would undo the damage that COVID-19 has inflicted on the economy. After the chaos and despair of the year gone by, through which we have sailed together and shall continue to sail ahead, the overall situation can best be described in the words of Mahatma Gandhi, and I quote, "We are daily witnessing the phenomenon of the impossible of yesterday becoming the possible of today."
All right, let's get down to it. Kaushik, let me begin with you and just your overall take on what you saw from the monetary policy. It all sounded very hunky-dory, but bond markets were quite spooked. What was the reason for this?
Okay, hi Tamanna. There are three things to look for in the monetary policy today. So one is obviously, as you said, like growth was pretty RBI was pretty upbeat on the growth outlook, and they put a 10.5% real GDP growth number. And they're saying that growth will improve from here on in all the quarters successively. April-June quarter of 2021, RBI has given a forecast of 26% growth, because last year, April-June, we were down minus 24%. So that's the positive part of the story, that growth is going to be much better going forward. But it also means then you have lesser, reason for cutting rates or, bringing down rates lower. And to think about that in terms of inflation, RBI has put a number of 5% inflation on an average till September, and only in October, December that they're expecting inflation to come down to 4.3%. As you know, in RBI's inflation targeting mandate, tells them to maintain inflation around the 4% range, and RBI is saying it'll be around 5% on an average, and growth would be in double digits. So obviously, there is no reason for RBI to ease rates. Then the third aspect of it is what do you do with the government borrowing program, which is like huge because government has tried to support growth, and fiscal deficit has been higher, and therefore the market borrowing has been kind of increased. So over there, the market wanted to hear from RBI, explicitly stating that they will do open market purchases. Some people were looking for an OMO calendar. Some people were looking for an increase in the HTM limit from 19.5% to 22% that was done, maybe another 2% higher than that. So those announcements did not come, although RBI assured markets that they will kind of take care of the borrowing program. And what else we got was that the CRR reversal of 100 basis points, that announcement was made today, that it will be done in 2 stages in March and May. So on the balance, things were positive on the growth front, but given the fact that RBI did not commit or did not talk about certain aspects which would have pleased the bond market directly, that kind of led to bond yields kind of going up today. And hopefully over the next few weeks, we'll see RBI taking actual actions to cool down the bond yields, going ahead.
Upasna, your first take on the first cut really of the monetary policy, but I also want to get a sense from you on where you see the RBI stands directionally on inflation. Would it be incorrect to say that a slightly higher tolerance is developing to higher inflation?
Tamanna, I'm not sure, the voice is not very clear, but if the first take on the monetary policy, the way I look at this is clearly, like Kaushik pointed out, they have been upbeat on growth, they have been upbeat on inflation. And as we go ahead, this is the first signal going ahead in terms of suggesting that we are slowly and gradually moving towards the path of normalization. So, some sound bites were got about from the previous minutes of the meeting as well, from the December meeting. And now in the policy statement itself, the fact that the RBI has acknowledged a reasonably decent pickup in growth, along with that much higher inflation, this clearly points towards the fact that RBI is kind of signaling to the market that we are going to be slowly undoing the excesses that were introduced during the pandemic season or during the pandemic time. And I think that is something which I would say is important to take away going ahead, because clearly the kind of, what the outcomes during the pandemic is that the operating target rate moved from the repo rate to the reverse repo rate. That has to be normalized. And that is something which over the course of next few quarters, I think we would see, wherein the overnight target rate should slowly start moving from below 3.35 to 4%. I think that is going to be the primary goal of RBI. And for that, various tools will have to be, applied. It could be through variable reverse repo, which is already started for 14 days. But this could be on a much more frequent basis through overnight variable reverse repo, or it could be through 7-day reverse repo, or maybe longer tenor. SDF is also a possibility, cannot be ruled out. MSS, I would want to reserve my view at this point in time, because RBI has clearly said that for now, they are not going to be touching on the quantum of liquidity. So clearly, it is not the quantum that they want to result in some kind of a spooking of a market going ahead. So they would not want to touch the quantum. But yes, the price of the overnight liquidity will continue to go higher. And that's what I would want to believe, because somewhere today's statements do kind of signal to me that we are going to be going ahead with some kind of normalization.
Yeah. Upasna, I hope you can hear me clearer. The second part of my question to you was specifically on inflation. And what kind of indication are we getting from the RBI today vis-a-vis inflation? Is there a higher tolerance growing to inflation which is likely to creep up?
Okay, so if I was to look at my own inflation trajectory, number one, it is slightly lower than RBI's estimates. So my sense is there would be a 20-30 basis positive surprise for RBI in terms of their projections for H1. And we will have to see how that really pans out. But having said that, as long as inflation doesn't threaten to go north of 5.5%, I would say that the pace of normalization is going to be very gradual. So to an extent, in the near term, I would say that, yes, there would be a higher threshold for inflation, which is going to be, like in the earlier, we used to look at 4% as being, the medium-term target. That still remains. But for some more time, given that growth is just recovering right away, we would be expecting that RBI would be relatively more tolerant for even a 5% inflation.
Kaushik, same question to you. More tolerance when it comes to inflation and expected to happen when the fiscal deficit is going to remain very large, as well as high growth that we're going to see this year?
So there are two aspects of this question that you asked to answer. One is obviously what Upasna said, that the projection that they've given 5% for the next few quarters already builds in some buffer for idiosyncratic, price shocks which keep on happening. Some food prices going up one particular month, oil prices could go up. So every time RBI will not want to revise their forecast upward, and therefore they would like to keep some buffer. So even if they see inflation averaging at 4.5% in a particular quarter, they would like to give 5% so that if there is any kind of shock which comes in suddenly, you don't have to revise the forecast upward. That doesn't mean that RBI wants to keep inflation at 5% and not 4%, and they would be kind of targeting 4% itself. Now, the second aspect of this question is what you're asking. There have been a lot of talk. The monetary policy framework is itself coming up for review. And, 31st March, we'll get to know whether this 4% midpoint target, whether that will be increased higher to 5% or not. There have been some talks on it. I think RBI is against it. RBI would want the midpoint to remain at 4%. But then there are better ways to target it, whether you look at core inflation along with headline inflation so that you can take a more, kind of broader call on the monetary policy stance. But this 5% doesn't mean that RBI, would tolerate higher inflation. But as Upasna mentioned, that, growth is still recovering. Output gap continues to be negative. Slowly, output gap would kind of close, and then we'll move to the, proper state where RBI can think about hiking rates. So I think any rate increase in the policy rate, in the repo rate front will only happen in early 2022. 2021, what will happen is that the reverse repo rate, which is at 335, will be brought to 375 by the end of the year. And the spread between the repo and reverse repo rate was at 25 basis points before the pre-pandemic, at the pre-pandemic level. So that will be adjusted, and then the question of raising the repo rate itself will come, which probably will happen in 2022. So one more year we have of kind of allowing the market to adjust to the gradual changes in liquidity and transitioning from the excessive accommodation that we had last year and slowly exiting from this accommodation.
Kaushik, just to follow up on an overall question, really, even as growth projections have been very optimistic this year, due to low base as well, 10.5% is what RBI is saying. IMF sees it at 11.5%. What are the headwinds you see coming up this year to those growth projections?
See, the problem with COVID is you can never be certain. I mean, there could be second waves, there could be, some bit of mutation at any point of time. And so all this linear progression that we have of forecasts that, the trajectory will follow as we are today might change. And, when it changes, it can be a little bit, different from what you're projecting at this stage. So the one risk is what happens with the COVID-19 situation, whether India continues to see the number falling and the vaccination picking up, and then you don't need to worry at all through FY22, which is what has been baked in. The second is if oil prices continue to go higher, that could put a shock to the consumer spending. And that petrol and diesel prices have already been increased quite significantly. A cess has been put on petrol and diesel prices. So oil prices, the input prices going up globally, that could lead to an inflation shock, and that could lead to consumer spending coming down, and therefore you could have problem with growth kind of tapering off compared to the expectations that we have at this stage. And India's growth would also be partly dependent on how the global economy is doing. So in order to do really well, you need that global support. But if the other parts of the world are not being very successful with COVID-19, and if you see problems happening in those parts of the world, then India will also have some bit of knock-on impact, will have a knock-on impact because of that negative growth impulse feeding into India. So global as well as the oil price risk, and then what happens domestically within India as far as COVID-19 is concerned will kind of determine the trajectory going forward. But I think the 10.5% number that RBI has given is pretty realistic, and it builds in some risk factors.
Yes. Possibly a more cautious, optimistic number there. Upasna, you want to come in on those questions? Everything looks hunky-dory. As of now, the numbers for COVID-19 have been relatively in control. Vaccination is rolling out, though could be quicker. But what are the headwinds that we could see, the risk factors that we could see going ahead?
I would agree with Kaushik. I think one of the most obvious headwinds is clearly if the way we are seeing the progress on vaccinations and the COVID cases coming down, if that doesn't materialize the way we are anticipating going ahead, then clearly there's a risk. Apart from that, I would say monsoons again poses a risk to the rural demand, because we've had 2 consecutive years of good monsoons, and the 3rd consecutive year, fairly high chance that we don't have a great monsoon. So we'll have to see how that really works out. The 3rd aspect is, of course, commodity prices. So the headwinds are going to be pretty strong when it comes to that. So we'll have to look at that too. My 4th worry is also in terms of sustenance of demand. Because of the K-shaped recovery that we've seen in the recent months, we have very little data to validate how the informal sector is recovering. So we know they have been affected most, but we don't know how well they are recovering out of this pandemic. We are more sure on the formal sector, how that has been recovering. All the high frequency data is largely depicting how the formal sector is recovering, and that's clearly faster than what we are seeing. But we still don't have adequate data to validate how the informal sector is going to be back. And unless we don't see that really on track, the second half, there could be a risk to the second half growth projections that we all are probably looking at. So for me also, we are expecting GDP growth at 9.3%. This was pre-budget, but I would say that RBI's numbers now post-budget are much more realistic, not optimistic and not conservative. I would say much more realistic to that extent.
Well, we'll have to wait and see how that growth story pans out going ahead. Thank you so much, Kaushik Das and Upasna Bhardwaj, for joining us and breaking down the monetary policy this evening. Another very important change and announcement that was made, Shaktikanta Das called it a structural reform, was allowing retail participation in government securities. Now, what is this new method of investment and is it worth your while? My colleague Mubina Kapasi breaks it down.
The RBI has opened its doors for investors like you and me now to buy and sell government securities directly from the central bank. So essentially now we're allowed to open what we call as a gilt account with the RBI. It will work like a demat account. The exception, or the difference rather, is that instead of buying and selling shares, we'll buy and sell government securities. Of course, we can do that now too, but it's through a more indirect route and it's for a few investors. And there are lots of other conditions as well that come along with it. There's this whole non-competitive bidding process. Then, you can buy through exchanges as well, which in turn will aggregate all the government securities demand, put it forward to the RBI. This is a bit of a more direct route. Now, remember though that, when it comes to government securities, firstly, the complexity of the fixed income market is something that's beyond many retail investors. Secondly, the rate of return as well sometimes can be pretty disappointing. Imagine being locked in at 6% for the next 10 years. A bank FD today would, have better chances of giving better returns. Of course, the biggest pro is that you get complete and absolute safety of your capital, of your return as well in a government security. But again, in the budget as well, the FM had said that the deposit insurance of 5 lakh rupees, which is there in case if a bank fails, will be available immediately now, as opposed to, waiting for the entire process to go by. So that's an added comfort factor as well from the government for banks. And let's not forget, of course, you have the whole gilt fund route as well, where you have expert managers doing this very job. Gilt funds have given double-digit returns, so that may as well be a great way to get GSEC exposure.